It's been anticipated for a little while now, but we now have confirmation that the Arcadia retail empire has collapsed, putting 13,000 jobs at risk here in the UK. But what about the pension scheme? What are the implications of Arcadia's collapse for current and future pensioners? I'm going to explain in this video what you need to know about future benefits from the Arcadia pension scheme. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice, and in this video I'm looking at the collapse of the Arcadia retail empire, putting around 13,000 jobs at risk across 444 sites here in the UK, plus some overseas locations too. Now, this news was widely anticipated. It's been making the headlines for the past few days, and lots of focus at the moment on the risk to the staff members, those 13,000 people, of which I believe about 9,000 are currently on furlough already because of coronavirus. But a big impact, of course, on the staff members in this retail empire. But what about the pension scheme? And that's what I'm going to be taking a closer look at in this video, explaining what protections are in place for pensioners, both existing pensioners who are getting money from a pension scheme already, but also future pensioners, people who have accrued benefits in these Arcadia pension schemes. So I'm going to explain all of that in plain English to explain what you can expect from protection around these pension schemes. But before that, please do press the subscribe button to find out more about videos we publish here on this channel. I talk about personal finance, investing, economics, and also happiness here. So press subscribe so you don't miss out on any future videos. So quite late yesterday evening, we had confirmation that Arcadia has gone into administration. The company has gone bust. And this is perhaps the single biggest corporate failure to date during the coronavirus pandemic here in the UK. Arcadia was the retail empire with brands including Topshop, Topman, Burton's, Dorothy Perkins, plenty of others too, and really a big name on the high street, and with a big tycoon owner, Sir Philip Green, behind it. So it would often make headlines when there were stories about capitalism and the future of the high street, the future of retail. So we've got Deloitte being appointed as administrators, and they will be working hard right now to try and find buyers for the group to try and secure a future for at least some of those brands. But what about the pensioners? What about people who have accrued benefits in either of the Arcadia Group pension schemes? And what sort of protection will they receive in the future? Deloitte have been appointed as administrators for the Arcadia Group, and they'll be working hard right now to try and secure buyers for parts of the business, so the parts that can be sold off and will hopefully survive in the future. Arcadia Group's chief executive Ian Grabiner said it was an incredibly sad day for the business and blamed the impact of the coronavirus pandemic on the failure. When Arcadia was restructured last year, Arcadia agreed to a £385 million top-up to the Arcadia pension scheme, and that was agreed with regulators, with money coming from the sale of some assets within Arcadia itself, but also donations, payments from Sir Philip Green's family. So what does the failure of Arcadia mean for the pension schemes? There's an estimated 10,000 people affected here. So these are members of the defined benefit or final salary pension schemes. Actually, two of them, the Arcadia Group pension scheme, and the rest a minority in the Arcadia Group senior executives pension scheme. But these are the defined benefit or final salary pension schemes. So the pension schemes that offered a promise of a future pension in the future, often referred to as gold-plated pensions. Very generous terms from them. This is not about defined contribution or money purchase workplace pensions where you accumulate a pot of invested money which you then use to buy or pay for your pension benefits in the future. This is the final salary scheme we're referring to here, which is at some risk as a result of the collapse of Arcadia, which was its sponsoring employer. So you have the scheme, the pension scheme, distinct and separate from the business, which is the business that sponsored the scheme and paid money into the scheme each year. These pension schemes are believed to have a shortfall of around £350 million. So that's a shortfall between the amounts of future pension promises that have been made by the schemes and the assets owned by the pension schemes available to meet and pay for those promises. And it's quite common for a defined benefit pension scheme to have a shortfall. That's not unusual. Even the size, £350 million, isn't a particularly excessive shortfall for a business this large, for a pension scheme this large. But It's only problematic when the sponsoring employer goes bust, because all of a sudden you've lost your lifeline, you've lost your source of funding for that shortfall to make good as pension payments are required. So failure of the sponsoring employer, Arcadia, likely means that the pension schemes will now fall under the terms of the Pension Protection Fund. This is a compensation scheme. It's arranged by the government, but it's funded in the main by a levy on other defined benefit pension schemes. So they pay an annual fee to pay for this compensation scheme. And the terms of the Pension Protection Fund, the PPF, will vary slightly depending on what stage of the journey you're at, what stage of the pension journey you're at. Really, it depends on your age. So depending on whether you're already retired and you're past the scheme pension age, or you're due to retire, that will depend on how much money, how much compensation you're going to get from the PPF. In a statement, the trustees of the Arcadia pension schemes said, because Arcadia Group Limited is in administration, the schemes are now expected to enter a Pension Protection Fund PPF assessment period. The trustees will now liaise closely with the administrators while continuing to work with the pensions regulator and the Pension Protection Fund to ensure the best return possible is achieved from asset sales and to make sure the scheme's entry to PPF assessment is as seamless as possible. Now, assuming that the schemes enter the Pension Protection Fund, what can you expect to get as a pension scheme member, as a pensioner with Arcadia? If you're already in receipt of your pension payments from Arcadia and you've already gone past the scheme retirement age, then the Pension Protection Fund will promise to pay your pension income in full. And that sounds like great news. It is great news, but you may see a reduced pension income in the future. And that's because of the way the Pension Protection Fund applies inflation and the way they uprate your pension income in the future. So two elements to consider there. Firstly, the Pension Protection Fund uses the Consumer Prices Index, the CPI measure of price inflation, and that's typically less generous than the Retail Price Index or RPI measure of price inflation. So pension schemes like Arcadia typically use RPI to increase the pension in payment each year, whereas the Pension Protection Fund limits those increases to CPI, which is typically, as I said, a less generous measure. So that's a first slight disadvantage of Pension Protection Fund versus the pension scheme. The second, though, is that those increases, those annual increases to your pension income, will only apply to pension benefits that were built up after 1997. So for older pensioners, many of the people actually who are approaching retirement age now, the pre-1997 accrued benefits won't be subject to inflationary increases at all. So over time, the buying power of your pension, which will stay level for those pre-1997 increases, will erode. So price inflation, the cost of goods and services will go up, but your pension income on that pre-1997 bit anyway will remain level. And for the the after 1997 bit, that will increase, but at a less generous rate. And for people who have not yet reached the scheme retirement age, or for people who have retired early and are now younger than that scheme retirement age, the Pension Protection Fund promises to pay 90%, 90% of your promised pension income. However, that 90% promise is capped, and at age 65 it is capped at £37,315 a year. So for pensioners with a higher pension entitlement, it won't be 90%, I'm afraid. It will actually be lower effectively because of that annual cap. So on average, someone who has not yet retired might expect to receive between about 75 and 80% of their pension entitlement should the schemes fall under the control of the Pension Protection Fund. There is going to be an awful lot of debate, an awful lot of headlines over the coming days, weeks and months about the moral obligation of Sir Philip Green and his family to top up this pension fund, top up that shortfall, that estimated shortfall of £350 million. So you're going to see photographs in the media of his super yacht. You're going to hear lots of references to the £1.2 billion dividend that Lady Green received back in 2005 from a business. And politicians, of course, will get involved to score political points. In fact, we've already seen Stephen Timms, who is a Labour MP, chair of the Work and Pensions Committee, say whatever happens to the group, the Green family must make good the deficit in the Arcadia pension fund. But morals aside, it doesn't actually matter. It doesn't make any difference to the benefits from a pension protection fund whether or not Sir Philip Green and his family put their hand in their pocket and pay into the existing pension funds. Whether that pension scheme enters the PPF with a deficit or not is not really an issue for existing and future pensioners. The PPF will provide the same level of benefits regardless of that outcome. So we'll see lots of headlines, we'll see lots of moralistic opinions about this, but the reality is here, it doesn't make any difference to the benefits you'll receive as a pensioner, whether or not Sir Philip and his family pay in. Commenting on the process that's going to happen now, the Pension Protection Fund said insolvency events are a concerning time for employees and scheme members, and we want to assure the members of Arcadia's defined benefit pension schemes of our ongoing protection. The robust negotiations at the time of the CVA last year have ensured that both schemes are now in a better financial position. So if you're a pensioner in either of these pension schemes, or in fact if you're a pensioner in another defined benefit pension scheme within the retail sector and you're worried about the future, all I can really offer to you right now is to say the Pension Protection Fund is in place, it's well resourced, it is there as your safety net, and you really do have to adopt a wait and see approach right now as news develops, as Deloitte, as the administrators try and sell off parts of the business to other buyers hopefully, and we'll see whether the buyers of those parts of a business are willing to take on the pension liabilities at the same time. Probably quite unlikely that they would do, because why would you buy a liability if you can just buy an asset? But we'll see what the outcome is. But worst case scenario here is that the pension scheme falls into the pension protection fund and you receive the level of benefits I've outlined in this video. One final point I would make is that often at times like this, the vultures are circling. So watch out for dodgy advisors who try to convince you to try and move your pension scheme. It won't be possible, by the way, to move your pension benefits from Arcadia pension schemes right now anyway. That will be effectively frozen. But look out for people who try and prey on vulnerability at times like this. They try and prey on your fears, on your worries about quite an unsettling time, understandably. Just look out for that. Don't take any rash decisions. Make sure you seek professional advice from a fully regulated and authorised financial advisor who knows what they're doing. Seek a second opinion if you need to. Now, I hope the information in this video has been useful. Please do press the like button down below. Leave me a comment if you have any questions or would like to share any opinions on this particular subject. And make sure you press that subscribe button too so you don't miss out on any future videos. Until next time, thank you for watching. I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.